Welcome to Accounting with Madam Mombi. Today we are going to continue with partnership and do a second question. So if you have not watched part 1, I would wish that you watch part 1 first so that you're able to follow and understand part 2 of partnership accounts. We are going to look at a question whereby, in this case, you are supposed to prepare an income statement first before you prepare the appropriation account. In our previous example, we only had a case where the profit had already been determined, and our work was simply to provide the appropriation account, current account, and the statement of financial position. So for us to achieve this, we have a question here. So it reads, that Sarah and Lydia are in a partnership as general traders. The following balances are extracted from their books as at 31st May 2017. We have the debit side and the credit side. The first is the capital balances. Sarah and Lydia, 30,000, 10,000 respectively. Current account balances of Sarah and Lydia, 3,000 and 5,000 respectively. We have the sales, which is 150,000. Inventory, which is the opening stock, at 30,000. We have wages, rent, general expenses, electricity. All those are expenses of the business. We have trade payables at 14,000. Trade receivables at 14,000 and trade payables at 10,800. Also, we have carriage outwards, 5,300. Drawings, cash in hand, equipment. You are given here the net book value. It's important to note that this is not the cost, but the net book value as at 1st of April 2016, which is the beginning of the year. Finally, you have purchases as follows. So take some time to capture the question, but does not end here. We also have some additional information. So the additional information says that, additional information number 1, it says that inventory as at 31st March 2017, which we are calling the closing stock, is valued at 40 million. Depreciation on equipment is to be provided at the rate of 25% per annum on reducing balance basis. Profits and losses to be shared equally between the partners after allowing annual salaries of 2 million to Sarah and 4 million to Lydia. Allow interest of 5% per annum on the balances of each partner, that is the interest on capital. And then you're going to charge Sarah 200,000 and Lydia 300,000 interest on drawings. And the balances of the capital account are going to remain unchanged, so all adjustments we are going to make in the current account. Therefore, required, prepare an income and appropriation statement, the current account and the statement of financial position. I am going to attach this question as a part of this video. But if you have captured it, then we can move on and try to compute it. So, for us to achieve our objective, we are going, number 1, we are going to start with the additional information. The workings from the additional information. So we start with the workings. Our first additional information read, inventory as at 31st March 2017 was valued at 40 million. This one we did no working. That is the closing stock. The second additional information says that depreciation on equipment is to be provided at the rate of 25% per annum on reducing balance basis. So we are going to do our working number 1. All our workings, we are going to omit 3 zeros and say that all our workings have 3 more zeros. So we are going to work with the workings with the less 3 zeros. Working number 1 here is depreciation. on equipment, which is going to be 25% per annum. And our method of depreciation is reducing balance. When you're using reducing balance method, we multiply with the net book value. And we had been given the net book value of the asset as 6,000. So we are going to multiply with the net book value. This is going to give us 1,500. And I've said this is the net book value, the 6,000 here. Had we been told that this depreciation is on straight line method, we would have multiplied here with the cost of the asset. But our method of depreciation in our question is reducing balance method. That is the difference between the two methods. Straight line, you multiply with the cost. Reducing balance, you multiply with the net book value. Our second working, it says that profits and losses should be shared equally. We are going to do this later in the appropriation account. Let's move on. Annual salaries of 2 million are going to be given to Sarah and 4 million to Lydia. We can just note that one, but there's no working. We say that salaries, Sarah and Lydia are going to be given 2 million, so we are going to just say 2,000. Remember that we are omitting 3 zeros, meaning our workings have 3 more zeros. And Lydia is going to be given 4,000. Which we are simply going to write here as 4,000. Then you are told working number 2 is going to be, this one we have said we are just noting information. Allow interest of 5% on capital. So we are going to compute interest on capital. So interest on capital, we have Sarah, we have Lydia. And you are being told to allow them interest on capital at 5%. Then you have to multiply this with their capital balances. So going back to our question, the capital balances are 30,000 and 10,000 respectively. This gives us, we have 1,500 and 500. Those are the interests on capital. The next information, it says charge Sarah 200,000 and Lydia 300,000 as interest on drawings. So again, this one we are just noting interest on drawings. We are noting that Sarah 200, remember the 3 zeros up there, and Lydia 300. So those ones we are just noting. These are our additional information, the few of them. They are just simply giving us here 2 workings. The other information we are noting. So we can move forward and prepare the income statement and the appropriation account. I'm going to open a new page. So we are in the second page. We can start now by preparing the income statement. And appropriation statement. It is for the year ended 31st March. $2017. So we are going to have 2 columns in shillings there. Don't forget that our columns or our workings, we have 3 zeros up there to represent that the figures are in thousands. Now, to know the income statement, we start with sales. How many units did they sell and how much revenue did they get from the sales? So our first item here is going to be sales. Sales, we can also replace there with revenue. So this I'm saying can also be revenue. And from our question, the revenue is 150,000. The sales is 150,000, which we are going to place here as 150,000. We are also going to check whether is it possible that some of the people to whom we sold returned the goods. So we are going to check from our question whether there is return inward. In our question there was no return inward, meaning there were no returns, which in case there were returns we would have to subtract from the sales figure to get the net sales. But having there been none, we can go to the next part, which is less cost of sales. We are going to less the cost of sales. That is, at how much had this been bought? The items that we are selling, at how much had they also been bought, or how much had they costed us? So we can start with opening stock. Opening stock. Our opening inventory, we have it there. It is called inventory as at 1st April 2016. That is the figure we are calling opening stock. Another name for stock is inventory. It is 30,000. We add purchases. We add purchases. Our purchases figure is given at the bottom of our trial balance, is the last figure, as 109,300. Once we get the purchases figure, we also need to consider some few things like, were the purchases carried in at a cost? So is there any cost of carriage, which we call carriage inward? If there is carriage inward, we add to the cost of purchases, because it represents the cost of bringing the purchases to the premises of sale. In our question, we do not have carriage inward. We also check whether there is purchases returns or returns outwards. Among the items we purchased, is it possible that some of the items did not meet qualification and had to be returned to the supplier? So again, in our question, there is no return outward. Had there been a return outward, we would subtract from the sales. So in our question, there is no carriage inward, which we would have added. There is also no return outward, which we would have subtracted. So therefore, the total of the two items gives us the cost of goods available for sale. So the cost of goods available for sale, from which we less the closing inventory to be able to get the cost of sales. So we less closing inventory. We have said inventory is another name for stock. Our closing inventory is given in additional information number 1 as 40 million. By lessing 3 zeros from it, it is going to be 40,000. This is 40 million because you have 3 more zeros up there. So this one, the total of all that gives us a cost of sales as 99,300, which we subtract from 150,000 minus the cost of sales to be able to get the gross profit. So we are saying sales minus cost of sales is going to give us gross profit. The gross profit is 50,700. 50,700. At this point, we add other incomes like discount received, rental income, and incomes are usually credited in the trial balance. So you simply have just to look at the credit side of our trial balance and see whether there are other incomes. And from our question, there are no other incomes. So therefore, we are going to go and less expenses. So expenses are debited. So again, we are going to concentrate on the debit side of our trial balance to identify expenses. Our first there expense is wages. So the first expense is wages. We have been told that wages here, which represents the salaries, was 14,500. Then you have rent. How do I know that this rent is not an income? It is an expense. It is simply because it is on the debit side of the trial balance. And in the debit side, you find expenses and assets. On the credit side, that is where we would find revenues and capital. So rent here is an expense, which is 5,000. You have a general expense, which is 3,000. You have electricity at 1,200. You have carriage outwards. This time, the business is the one carrying for the customers the goods to their premises. So carriage outwards is an after-sale service where you carry the commodities for your customers to their place of maybe usage. If it is probably gas, you carry the gas to the customer's house. That is carriage outward, which is 5,300. Then finally, from our workings, which we had previously, we have one more expense here, which we got here from working number 1, which was depreciation. So we are not going to forget this expense from our working. Our first expense, our first working here represented an expense, which is the depreciation. So here we are going to note the depreciation as an expense. Then I'm going to note that that is from working number 1. So do not forget working number 1. And it is giving us 1,500. And this gives us the total of all our expenses from our trial balance. And I don't see any other expense from our trial balance. The total of this expense is 30,500. 30,500. We are saying that the total is 30,500, which we are going to less again. From the figure for gross profit, we are going to less the total expenses from which we get the net profit. So our net profit is going to be 20,200. So we have not finished our question because we need the income statement and the appropriation statement. This is simply the income statement. So we can move on now to the appropriation statement. I'm going to add another column. So in the appropriation statement, we start with net profit. Net profit. Remember, we are also going to have the columns, 2 of them here. Shillings in thousand, shillings in thousands. So our net profit from the previous slide that we have here, our net profit is 20,200. Moving on is the one we are starting with here. We are starting with 20,200. Now, appropriation account looks at the affairs of the partners amongst themselves. So before the partners share this profit, they have to agree on several issues. Number 1, if you took any money in form of drawings, you have to bring the interest on drawings, which we are going to add to this money. So we can add that. We start with add interest on drawings. We have Sarah, we have Lydia. Their interest on drawings we had noted in our number 1 slide. We noted that the interest on drawing was 200 and 300 respectively. So we are just going to pick those figures, 200 and 300 respectively. So this is 200 and 300, giving us a total of 500. We are adding to the net profit because the partners are the ones who are bringing in the interest on drawings. Or they are the ones who are going to bear this cost because they are the ones who took up some goods or withdrew some money, so they are paying interest on drawings. Then we are going to pay the partners their salaries. So we are going to less salaries to partners. So we are lessing the salaries to partners. Again, from our question, we noted that the salaries to partners is 2,000 and 4,000 respectively, which we are going to bring back here. So the salaries to the partners we are saying is 2,000. The salaries to partners is 2,000 and 4,000 respectively. We are the ones who are paying. As the accountant, you are the one who is paying the salaries to the partners. We are lessing these salaries of 6,000 from this money, which is a profit. These are the affairs of the partners. What we were doing before was the affairs of the business in form of an income statement. Then we are going to also pay the partners their interest on drawings from this profit. Interest on, not interest on drawings, but interest on capital, interest on capital. Sorry for that. We are going to pay them interest on capital. For the money that they have invested, we are giving them a percentage of 5%, which is their interest on capital. So without going back, we know that the interest on capital we computed as 1,500 and 500 respectively. So this was our working number 2, which we did there. We can note here that it is working number 2. And you can see it there. It was working number 2, which gave us interest on capital of 1,500 and 500 respectively. And this is what we are carrying now to our appropriation account. We are saying that we are paying the partners this amount. And by the way, these 3 items can be in any form. You can start with any of them in any order. So again, here interest on capital in total is going to be 2,000. Once we do the computation, the answer we get is what we call the profit to be shared. Profit to be shared. So our profit to be shared is 12,700. That is our profit to be shared. Then you share the profit. Remember, in our additional information, we were told that the profit should be shared equally. So you give Sarah and Lydia each half of this amount, which is 6350 and 6350. Meaning the balance of this account is going to be 0, because at the end of the day, you are going to distribute the money to the partners. Once you finish this is the appropriation account. We have now to prepare the current account. Simply, these items that we have said are either being received by the partners or being paid by the partners have now to be put in their current account. So, I'll add one more slide. You can have now the current account. Partners current account. We have the details, and we have the partners Sarah and Lydia. On the other side, you also have the same details, and you have Sarah and Lydia. So the opening balances of this account are given in the trial balance. So going back to our question, in the trial balance, the opening balances of this account were 3,000, and their credit balances, balance brought down or brought forward, are 3,000 and 5,000 respectively. And they are saying that their credit balance, because in the trial balance we are finding them on the credit side. So for anything that the partners receive, we are going to credit to this account. Now, what did the partners receive? Partners are going to receive salaries. These two. Partners are also going to receive interest on capital. Partners are also going to receive a share of profit. For anything they receive here in the appropriation account, we are going to put in their current account here. So we can start very quickly with salaries. They are going to receive salaries of 2,000 and 4,000 respectively. They are also going to receive interest on capital. interest on capital. We are saying they are receiving 1,500 and 500. And they are going to receive a share of profit of 63.50 and 63.50 respectively. On the other side of this account, they are going to pay interest on drawings, interest on drawings of 200 and 300 respectively. The only item that is not in the appropriation account that is going to be in this current account is the drawings. So finally, we have to put the drawings here. And the drawings, according to our trial balance, was 7,000 and 9,000 respectively. Now these figures are in thousands and these figures are also in thousands. Now what is left is to balance our account. And how do we balance our account? We check how much did the partner have in total in the receiving and how much did they pay. So in this column we find that the total is 12,850. When I say pay, it would also mean how much did they take out or how much did they withdraw. Because this is 1,850. If you subtract 7,200, the balance here is what you're calling the balance carried down, which you are saying for this account it is 56.50, and this now if you add, you get the total to be the same as 12,850. And you do the same for the other partner. How much did they get in total? This partner got 15,850 on this side, and then you less 9,300. You get here the balance carried down is 6,550, which now gives us the total here to be 15,850. And those balances that are closing there, they are the balances brought down. When you open this account, it is going to have here a balance of 56.50, this one's, and 65.50. So if you do not know how to balance an account, I would advise that you look at a video where I have explained on the part 2 of accounting cycle on how you balance a ledger account. Because at this point I am assuming you already know how to balance an account. But this is how we balance our account. So this simply leaves us with just one more item, which is to prepare the statement of financial position or the balance sheet. So having prepared the current account, now we can move on to the balance sheet or statement of financial position. Our statement of financial position, we are going to have here 3 columns. So we can start with the net book value, which I want us to do here as a working. The net book value as at 1st April was 6,000. 2016. That is 1st April 2016. At the opening, when you are beginning, during the year, we have charged depreciation. So during the year, we have I'm saying we have charged depreciation of 1,500. And this is a working I am doing here. What does that leave us with? We began, the asset had a net book value at the beginning of the year of 6,000. During the year, we have charged depreciation of 1,500. This leaves us with a net book value of 4,500. So I'm going to put here that the non-current asset is the equipment, whose net book value is 4,500. The reason I am not putting in other columns is because we do not know the cost of the assets. We may not also know the accumulated depreciation because we had only been given even initially the net book value. So, moving on, we have the current assets. Current assets. In our question, the current assets that we have trade receivables. That is another name for debtors. We have trade receivables. Trade receivables. The trade receivables is 14,000. We are going to use the middle column. We also have cash in hand. Cash in hand, which is 4,500. We have a stock, that is closing inventory of 40 million, which again we are saying here is 40,000 because the 3 zeros are up there. And this gives us a total of 58,500. We move on and come to the current liabilities. Current liabilities. Again, if you do not know how to prepare a balance sheet, you have to refer to a video that you have done before on preparation of financial statements to be able to understand where these are coming from. The liabilities we had in our question is the trade payables. These are the amounts that are payable within a period of 1 year, and we do not have any other current liability in our question. Therefore, we can easily just quickly subtract that from here, which is 10,800. The difference of current asset minus current liabilities, you minus. The answer you get is what you call working capital, which is 47,700. Again, we add this to be able to get the net assets. The net assets, which is 52,200, which is our net assets. So that is one part of our balance sheet. And finally, we have the financed by what? Financed by capital. We are going to bring in the capital of the partners, Sarah and Lydia, and you're also going to bring their current account balances, also of Sarah and Lydia. So for the capital balances, they are provided in the trial balance. In our trial balances, 30,000 and 10,000 respectively. For the current account balances is what we have done just previously here. These are the balances we are talking about from the current account. So coming back, the balances are 56, 50, and 65.50 from the current account. This, if you add again, it gives us the same answer as this, which is 52,200. And that is the end of our balance sheet and also the end of our lesson. If you found it important, like, share, and subscribe. Watch out for more. Thank you.